Welcome to the deep dive. Today, we're really getting into the weeds on some big global economic trends.
We are. We're looking at a report, Greed and Fear Off-Ramps and China and Japan from May 1st, 2025.
Right. And the idea is to untack what's going on with international trade, specifically, U.S. tariffs and how China and Japan are navigating all this.
We'll touch on trade data, consumer feelings, government moves, even stock market stuff.
Exactly. We want to give you the key insights, the main trends, potential turning points without drowning you in, well, endless numbers, just the crucial bits.
Okay, so where should we start? The report really flags this U.S.-China tariff situation, doesn't it?
It does. It notes things have gone a bit quiet on the news front lately, but the core problems, they're definitely still there.
And the analysis argues pretty strongly, actually, that the U.S. might not have a whole lot of leverage over China on tariffs.
Yeah, that's a key point. Beijing's position seems pretty firm.
Yeah.
No tariff cuts unless the U.S. moves first. Their argument being, well, the Trump administration started this trade war.
Right, it kind of flips the usual power dynamic you might expect.
It does, and it makes you think about the U.S. strategy, trying to isolate China somewhat by doing deals with other countries like Japan or India.
But China's not exactly sitting back, is it? They've put out warnings, basically telling countries not to make deals with the U.S. that hurt China's interests.
And the report brings in some data that really gives those warnings some teeth. It's quite striking.
What does it show?
Well, get this. In 2024, 71% of countries, that's 143 nations, traded more with China than with the U.S.
71%? Wow.
And maybe even more telling, 53%, over half, traded more than twice as much with China as with the U.S.
That's a huge jump from, say, 2001 when China joined the WTO.
Exactly. Back then it was only 22% and 11%. It just shows how interconnected things are now, with China often at the center for many economies. It really complicates any U.S. strategy based purely on pressure.
Definitely puts things in perspective.
Right.
So given that reality, the report kind of floats an idea, a potential off-ramp for the U.S.
What's the suggestion?
It's just a suggestion, mind you, not a prediction. But it's the idea of maybe a universal 10% tariff on imports from all countries.
Interesting. Sort of simplifying things, moving away from the targeted approach.
Kind of levels the playing field, maybe. Sidesteps the really contentious bilateral stuff.
Okay, so that's the big picture trade tension. How is this playing out, for regular people, say, in the U.S.? The report mentions consumer sentiment.
Yeah, the University of Michigan index. And it's taken a pretty significant dive.
How bad is it?
It hit 52.2 in April 2025. That's actually the fourth lowest reading ever recorded for that index.
Fourth lowest. Wow. When are the other lows?
Mid-2022 during those sharp economic jitters and way back in the early 1980s.
So that signals some serious unease among American consumers right now.
Definitely suggests that. Okay, so we see that impact in the U.S. What about China? How are they handling this pressure? Is Beijing hitting the panic button with stimulus?
Well, the report indicates. Not really. At least not aggressively. The April Politburo meeting didn't signal any major stimulus push.
Why not?
Seems to be partly President Xi's policy preferences, but also maybe a bit of wanting to avoid looking like they're panicking specifically because of U.S. tariffs.
Right, optics matter. But they must be acknowledging the risks.
Oh, absolutely. The meeting did recognize the external growth threat from tariffs. And the emphasis now seems to be shifting more towards boosting domestic consumption.
Focusing inwards.
Exactly. Especially helping out low and middle income groups and really trying to get the service sector going.
Is there anything specific on how they plan to do that?
Yeah, there's talk of a potential PBOC relending facility. Think of it as targeted loans, basically, channeled towards service sector consumption and, interestingly, care for the elderly.
Specific targets. And what about the role of trade in their growth? Is that changing?
It seems so. The report points out that net exports trade basically became a much bigger chunk of their GDP growth in the first quarter of 2025, almost 40%.
So, ironically, maybe more reliant on external demand right now, even with the tariff headwinds.
Yeah, it's an interesting dynamic. And we have seen some action from the PBOC, the People's Bank of China.
What have they done?
They did a recent injection of liquidity, about 500 billion renminbi, using their medium-term lending facility, the MLF. The report equates that to roughly a 25 basis point cut in the reserve requirement ratio for banks.
Okay, so some easing, but maybe not the big rate cuts some might have expected.
Right. And the feeling is more stimulus could come perhaps after the July Politburo meeting. It likely depends heavily on what happens with the tariff situation.
And that's probably why China's 10-year government bond yield has dipped a bit, reflecting those lowered stimulus expectations.
Seems plausible. There's also a constraint mentioned, something that limits how much they can cut rates.
Ah, the bank margins.
Exactly. Net interest margins, the difference between what banks earn on loans and pay on deposits, are apparently at a record low, hit 1.52% late last year.
So not much wiggle room for banks to absorb lower rates without hurting their own profits.
Precisely. But on the other side, the fiscal side, they are stepping up bond issuance, both treasury bonds and local government special bonds.
Which means more government spending can happen, and perhaps more quickly.
Yeah, it allows for faster fiscal action. Okay, let's pivot to stocks. How does this all translate to the market outlook, particularly for China?
Well, the lack of really aggressive stimulus, that might put a bit of a lid on near-term gains for China equities.
Makes sense.
But on the flip side, the report argues Chinese stocks look pretty attractive from a valuation standpoint, and crucially for diversification.
Because they don't just follow Wall Street.
Exactly. The correlation is low. The report cites MSCI China versus the MSCI AC World Index at just 0.16 since 2023, and the CSI 300 index is actually negatively correlated recently.
Minus 0.30 since 2023. Wow, that's quite something for diversification.
It really is. And interestingly, despite the broader economic picture, China's consumer confidence index actually nudged up slightly.
Okay, a small positive sign there. What about risks? Anything major flagged?
The big one mentioned, though deemed unlikely by the report's authors, is the potential for Washington to delist those U.S.-listed Chinese stocks, the ADRs.
That sounds like a huge deal. How much are we talking about?
Potentially $1 trillion worth of market cap. Now, American institutions hold maybe $250 billion of that.
Still a massive number.
It is. And the concern is, if they get delisted, maybe $225 billion of those ADRs might not have a secondary listing, like in Hong Kong, making them hard to trade for those U.S. holders.
But the report thinks it's unlikely.
That's their view. And interestingly, they suggest if it did happen, it could actually be a major buying opportunity for non-U.S. investors.
Huh. Europeans, maybe?
That's the suggestion. Maybe they wouldn't follow a U.S. delisting move.
Okay. Any other points on China's domestic situation? Property market?
Yeah, seems to be signs of stabilization in the residential property market in major cities.
Yeah.
And progress on that whitelist for property project loans.
The whitelist, that's the mechanism to ensure viable projects get funding, right?
Exactly. Apparently over 6 trillion renminbi worth of projects were approved for potential loans by early March this year. So some movement there.
Okay, let's shift gears now to Japan. How does the report see Japan fitting into this global picture?
Well, near term, the analysis seems to favor European equities over Japanese ones,
Why is that?
mainly pointing to a potential boost for Europe from an expected German fiscal expansion, a near-term macro catalyst.
Right. And what about Japan itself? There was a lot of buzz about corporate governance reforms there.
There was, especially in 2023, the Tokyo Stock Exchange pushing reforms. That really drew in foreign investment. But that seems to have cooled off a bit recently.
So foreign investors aren't as keen now.
They've actually been net sellers this year so far, after buying in 2023 and 2024.
But are there still positive things happening at the company level?
Oh, yeah. The report highlights a couple of interesting bottom-up developments. One is the Toyota Group chairman proposing a buyout of a key supplier, Toyota Industries, at a pretty big premium. And the other is Sony apparently considering spinning off its image sensor business. That could unlock value.
So some positive micro stories, but what about the macro picture in Japan, the Bank of Japan, the BOJ?
That's where things look a bit more challenging. Expectations for the BOJ to, normalize policy further, basically, raise rates more, those seem to be fading.
They decided against another rate hike recently, didn't they?
They did. And they also have their real GDP growth forecast for this fiscal year, cut it down from 1.1% to just 0.5%.
That's a big cut, signaling concerns about growth.
Seems that way. Money markets still price in some hikes, but expectations have definitely fallen. There's even a growing possibility the BOJ might be done tightening, especially if the U.S. Fed starts easing.
What's driving that caution?
Well, the stronger yen recently, it's up over 12% against the dollar since last July. That's eased imported inflation pressures.
Okay.
And their worries about deflationary pressures may be creeping back. M2 money supply growth is the lowest since 2006, and core inflation is trending down.
And Japan has a history of tightening policy too soon, right?
Exactly. The report mentions past instances where BOJ tightening got undermined by external shocks originating from the U.S., like the dot-com bust and the subprime crisis. So maybe some caution is warranted.
But it's not all negative, is it? What about wages?
That's the big positive story, really. Average monthly cash earnings were rising, and the spring wage negotiations, the shunto, resulted in significant increases.
What's driving that?
Partly demographics, labor shortages, but also more women and older workers participating in the workforce.
Interesting. And how are the bond markets behaving, U.S. versus Japan?
The traditional correlation seems to have broken down somewhat. They aren't moving in lockstep like they used to.
And are Japanese institutions like big pension funds or life insurers finally shifting money from bonds to stocks?
Doesn't look like it, not in a major way. The report notes there are no clear signs of that domestic reallocation. In fact, one major life insurer mentioned plans to increase exposure to private, unlisted alternative assets.
So not necessarily pouring into the public stock market.
Doesn't seem so. Even though the Topic Stock Index has massively outperformed Japanese government bonds, JGBs, since late 2012.
But volatility is higher in stocks, right?
Much higher. That might be a factor keeping institutions more anchored in fixed income or seeking alternatives.
Got it. And finally, the report mentions some specific portfolio changes they made.
Yeah, just a couple of examples. They added Nintendo to their Japan long-only portfolio, funded by trimming some financials. And in China, they increased Xiaomi, reducing Meituan, just reflecting their specific views on those companies.
Okay, so let's try and pull this all together. What are the main takeaways for you listening?
Well, first, that U.S.-China trade relationship. Still very tense, very complex. China's showing resilience, focusing more internally.
Right. And in the U.S., consumers are definitely feeling less confident. That sentiment index is quite low.
China's navigating carefully, avoiding huge stimulus for now, focusing on domestic demand. Meanwhile, Japan, well, it faces slowing growth, uncertainty about the BOJ's next moves, even with those positive wage trends and corporate reforms still bubbling away.
It really paints a picture of interconnected but also diverging paths for these major economies.
Absolutely. And maybe the final thought to leave you with is this. Considering how linked everything is, trade flows, policy decisions, market sentiment, if there is a significant shift, say, in U.S. tariff policy, how might that ripple outwards?
Yeah, what kind of unexpected domino effects could we see, not just in trade figures, but in investment strategies, maybe even in our daily lives as consumers across these different countries?
It's complex, and the knock-on effects could be quite surprising. Definitely something to keep watching in the months ahead.